Hi, everyone, and welcome to today's webinar. My name is Anna, and I'm with the New Mexico Small Business Development Center. Today, we have Amanda Davis joining us, who is a certified SCORE mentor, holds a bachelor's degree of business administration in accounting, and is the founder and owner of a business consulting and bookkeeping firm here in New Mexico. Amanda has guided many small businesses, creative professionals, and nonprofit organizations towards financial clarity and will be presenting basic bookkeeping. We will be using the Q&A function to take questions and welcome attendee participation. So don't hesitate to ask us any questions you may have. We'll answer questions at the end of the webinar and sometimes throughout as well. Kind of depends on how many attendees we have and how many questions we've got, but definitely don't be shy. And the following slide features some COVID-19 business resource links, which I won't go over in detail right now, but we will send you a copy of the presentation at the end of the webinar. So just know that all that information is coming to you via email. Lastly, please visit our website at nmsbdc.org to view our upcoming no-cost webinars or to sign up for our no-cost counseling services. I will also send a follow-up email to you with this information. Thanks so much for joining us. And without further ado, I'll hand it over to you, Amanda.
Well, thank you. To give us an idea of what we're doing, it's an introduction to bookkeeping. So this is a very basic course. If you haven't had a lot of interactions with bookkeeping and accounting, we're going to introduce some terminology, some basics, some principles, all of this good stuff. So our presentation outline is: why would you do bookkeeping? The principles and practices, financial statements, top mistakes to avoid, terminology, reports, and ratios. The objectives on this particular presentation is to hopefully understand the process and purpose of bookkeeping, understand why bookkeeping is important, understand bookkeeping and accounting terminology, understand the basic financial statements and basic financial ratios. The ratios we're going to go over, there are plenty of them. We are giving you kind of an introduction to them, so you can go further research that after this, but we'll just dive in. So what is bookkeeping? Modern bookkeeping was formally established in the late 15th century by an Italian mathematician and a monk. The described double entry bookkeeping was recorded in a book. And even though this is over 500 years old, the basics of accounting and bookkeeping really haven't changed much, but the practices have. So with the advancement of technology, the way that things are happening now are a little bit different. But in the olden days, when it first started, transactions actually were recorded in two separate places on physical paper, if you can believe it or not, the journal and the ledger. So the books had to be balanced each month. So this is known as the trial balance, and they were done before the statements could be prepared. So when we say double entry bookkeeping, you can think of both a journal and a ledger. And those two things are reconciled and then statements are prepared. So that's very exciting. With the way software and technology has improved, we have things like optical character recognition, OCR. We can connect your accounting software with your bank, and then they can pull in what comes over from your bank, which kind of changes the nature and the order of how things are recorded. There can be rules where you can create automation, and you can also capture images for the audit history, the audit trail, and all that good stuff. So what is bookkeeping? So accounting versus bookkeeping. You've heard the term accounting and you've heard the term bookkeeping, and they sound interchangeable, and they can be, but basically the concept of bookkeeping is recording and tracking data. So it's part of that management of record keeping and data. And so in terms of retention for your records, for 3 years, you want to keep correspondence, employment applications, internal audit reports. For 7 years, you want to keep bank statements, canceled checks. A canceled check is when you write a physical check from your bank account and somebody goes and cashes it. Then the bank will go ahead and cancel that check so it cannot be used again. And then some people will pay for those checks to be returned. as part of their audit trail or documentation. Expense reports, invoices to customers, invoices from vendors, personal records such as timesheets, sales records, and in your permanent file is tax returns and work papers. Now, you've heard with tax returns, keep it 3 years, keep it 7 years, and it's like, which is which? Well, the IRS can actually ask you for your tax returns if they think something's awry for as long as they want to go back. So it is best to keep those records. Anything used to create your tax return, the work papers, and the actual tax returns themselves, keep a file of them. And with the way the digital technology is going nowadays, there's a 333, I think is the terminology that I've heard, and I could be misquoting it. I'm not an IT expert or a risk management expert, but it seems like you should have them in 3 different places in case one is compromised, a physical location in case there is a fire. I'm in New Mexico, lots of fires happening right now around the state. So if you have a physical thing, if it's not in a firebox, that could be compromised or stolen. And if it's in a digital spot, you want it in multiple places, maybe on an external hard drive, and then maybe somewhere in the cloud or on your digital computer as well, so that you have multiple ways to access the information. Accounting is the use of that data. So it starts with the bookkeeping, and then the accounting takes that information to summarize the business's financial position and render financial advice, prepare a tax return, do an audit, or certify financial statements for lenders, buyers, and investors. So these are all things that accountant would do after the bookkeeping is done. Common bookkeeping tasks, you would record some data, so things that came over, receipts, bills, invoices, all of that good stuff, things that it takes to operate your business. There will be some general administrative stuff, office management, customer billing, paying vendors, processing payroll, end of period closing, which you could reconcile the accounts, what happened at the bank versus what you're showing in the books, making adjusting journal entries if you have depreciation that needs to be recorded or any such other type of activities that would create cause for a journal entry, reviewing the financial statements and locking the books so that once they are closed and reviewed and final, they cannot be altered after the fact. And then internal management reports, and this is more of an accounting term, whether your reports are used for external purposes or internal purposes. An external purpose is giving it to a lender, a creditor, an investor, somebody who is not inside the organization. Internal management would be, okay, you're a business owner, your managers, the people operating the day-to-day need to see whatever is happening. So they are looking at these reports, and instead of investing in the business or making decisions as an outsider looking in based on those reports, they are an insider looking at the inside information, making decisions on that. So the internal management reports would be the balance sheet, which is the assets equals liabilities plus shareholders' equity. Your income statement, which is also profit and loss, and it's your income and expenses. Your cash flow statement, which reconciles the income statement to the balance sheet, and it really identifies where did the cash go, come and go, how was it used. Accounts receivable and aging reports. Very exciting. Okay, top 10 mistakes and how to avoid them. So instead of labeling off a bunch of texts, I decided to show you this fun little scary video of this child freaking out because I think a lot of business owners feel this way whenever they hit roadblocks. So we're going to talk about the accounting and finance side of the world. So the SBA has a statistic that half of new businesses fail within 5 years due to poor financial management. Now, how would you know if you're failing as a new business within the first 5 years? How would you know if you're failing within any period of time that you've ever started a business, be it 5 years or 50 years? It's going to show up in your financials. So if you are not checking out your financials, you have no indicator of what's going on and what's going wrong or what's going right. So that's a big deal, is not paying attention. There's different accounting methods, which is accounting versus accrual. We're going to get into that a little bit more later. Intermingling personal and business expenses. This is my pet peeve. People have one bank account and they pay their personal rent and then they pay their employees' payroll out of the same account. You need to have separate business accounts and separate personal accounts. Even if you don't have a separate business ID or whatever, just open up a separate business account, please. There is liability issues, not to mention the headache that, well, did I go to that restaurant to take out a client, or did I take my family and we're doing it 6 months later? So we just don't remember, is this a business write-off or was this something personal? So it becomes a really big headache, and it also becomes an area of liability for you. So please, 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 if you have not yet done it, separate your business activity into separate bank accounts, separate credit card accounts, separate PayPal accounts, separate Venmo accounts, everything separate, please. You are creating a nightmare whenever you commingle. Amazon, don't do it. Zelle, everything separate. The business has their own accounts. The personal has their own accounts. Please, 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 please. Not reconciling accounts. If you don't do a bank reconciliation, you've got big problems on your hands. I have people and they're like, I have it on my phone. Like, we didn't used to have this on the iPhone, right? And so we can go in and look on your smartphone and see, oh, I know what the balance is, and I know that everything cleared is right. But at the end of the day, you really need to go in and tick and tie and make sure. I had a client one time, and their website got hacked, and a person came in, or I don't know, could have been a robot, who knows, it was some sort of hacker scammer. And they went in and processed a bunch of $1 payments through their website. And those $1 payments worked out to real merchant processor fees. So they pretended to pay with like a credit card, and then the credit card actually charged them a processing fee to process these fake $1 charges. And there was a lot in a short amount of time. So by not looking at that, that could have gone on for I don't know how long. I was the one who went in and told them about it. So pay attention, reconcile, go in and look. Lack of controls, access to physical assets, but also looking over the things that are digital as well. Access to things like paying your vendors, paying your employees, access to checks. We had a construction company here locally that had physical checks that they would print out, and somebody came in and was able to take multiple checks out of the middle of the stack. And because the rest of the controls were in place, there was no missing checks until they got to the middle of the stack, which allowed the activity to occur. And if you think that somebody writing a check to a bogus person and cashing it is going to get caught, I have a story for you. My parents, they were renting a property a long time ago, and their rent check was stolen out of their mailbox, out of my parents' mailbox. The rent check paid to them. They were the landlords. So somebody stole the check out of their mailbox. So that's physical, right? And that person endorsed the check Mickey Mouse. I am not kidding. Mickey Mouse. And the bank cashed it to that fake person endorsing it to Mickey Mouse. So be careful, have proper controls, and review everything. I know I'm making you panic, right? It's not that crazy, but these things do happen. So you need to be understanding that it can happen and have things in place so that they don't. Misunderstanding of profits versus cash. I had this conversation this morning, and human logic, the way people think, it is not that you're bad. You think that what is left at the in the bank at the end of the day is how much money you made, right? That makes a lot of sense because the money came in, the money went out, and what's left over is what you earned, and that's your profit. And that's so not true, because there are so many things that affect your profit, like depreciation, which is not an expense that came out of your account. Or if you purchased a car, let's say you bought a car with cash, well, you can't just deduct it that 1 year, you have to take it over a period of years. So there's so many reasons why what's in your bank account isn't what your profit is. And one other thing is income taxes, so it's all the stuff and things that are coming due, but is not owed yet. So what your profit is definitely not what your cash is. So this is why you do your bookkeeping. DIY bookkeeping. I am a proponent of DIY bookkeeping. I think doing it yourself is great. But at the end of the day, if you're doing it yourself and you're not understanding and you're not double checking, that can cause problems. No record keeping. That is way worse than doing it yourself and doing it wrong, in my opinion. It really creates problems because you have absolutely no idea where you are. Insufficient checks and balances. We kind of talked about that with the checks and the Mickey Mouse endorsement. That was really fun. And the lack of audit trails, not having documentation. So if something happens, not being able to identify A, what happened, and B, how it happened, so you can correct it. So here's the fun part for folks. We're going to nerd out on terminology. And I specifically left off the definitions here because this is a lot and it does not encompass everything. This is kind of a start. So you're going to get a copy of this PowerPoint presentation. So you're going to get these terms. And I encourage you, if you are unfamiliar with any of these terms, to go in and review them, research them, and go in and really get to know them. Some of these terms are going to mean more to you than others, but today we're going to just kind of go through them here as quickly as possible. And if I go a little bit fast, just know you are going to get the slides and we are going to have some time for Q&A afterwards. So here we go. The accounting equation. You may have heard this. When you hear the term balance sheet, the way a balance sheet balances is because assets equals liabilities plus shareholders' equity. So the total assets must equal the total liabilities and total equity in the entity. So you're going to see that a couple more times because it's a big deal. It's very important. But this gives you an idea of the ownership of the business. Accrual basis and cash basis. So we talked about having the wrong accounting, right, basis. So a cash basis is like money went in the bank and money left the bank. And so when money comes in the bank, you earn revenue. And when money leaves the bank, then you have a deduction, you have an expense. And accrual basis is, well, hey, this customer owes you because you performed the service or sold them the product, but they haven't quite paid you yet. But you're still going to recognize that income. Or the other way around, you bought something, but you haven't paid for it yet, like a credit card. So the difference between accrual and cash basis, I encourage you to work with your tax person to identify which way is going to be better for you, the most advantageous, the thing that's going to make the most sense. I do not encourage making business decisions about tax implications, but I do encourage business decisions to factor in tax implications because tax is not everything and tax will not run you a good business, but not understanding what happens with tax is going to cause you problems. So accrual basis is it happened, but the money hasn't been paid in or paid out. Cash basis is money has been paid out and that's the only time it is recognized. Assets is what your business owns. Assets includes things like cash, buildings, vehicles, patents, open invoices from customers, which is called accounts receivable, inventory, these types of items. The accounting period is a length of time it takes to complete the accounting cycle. Typically, you're going to be looking at this in terms of a month, a quarter, a year, whether it be a fiscal year or a calendar year. Accounts receivable, we talked about that. That's money that your customers owe you, but they haven't quite paid. You've heard the term net 10, net 15, net 30. That means how many days after the invoice is placed before they owe you the money. In my humble opinion, you are not in the business to lend money, so I don't know why you would, unless it benefits you from a business operation perspective. If it keeps a good relationship with your client, if you're working with a larger client that gets to dictate terms to you and it makes sense for you to work with that client. But any way that you can avoid, reduce receivables, I think is a better way to manage your business. Accounts payable is money that you owe to others. So it's the exact reverse of accounts receivable. Accounts receivable is money somebody owes you. Accounts payable is money you owe somebody. And that means like a credit card, you incurred charge, but you haven't paid the bill yet. That's all that means. And accrual is an income or an expense that has happened, but you haven't paid it yet. So that's basically the idea of accrual. A balance sheet is the comparison between all of your assets, your equity, and your liabilities. Assets are things you own. Liabilities are things you owe. and equity is things you own, things that kind of remain in a company, your ownership. Cash flow, money going in and out of your business. Chart of accounts, the listing of categories used to classify your business transactions. Think of the chart of accounts as a sort of filing system for your business's transactions. Things like, well, you went to Office Max, so what you purchased there is likely an office supply. Okay, well, maybe you went to a restaurant and took people out, so that's probably meals and entertainment. Maybe you paid a utility for the office space you use, so that would be a utility. It could be electric, it could be gas, it could be water and trash, but it still boils down to utility. So it's kind of your filing cabinet. Cost of goods sold is money your business spends to reduce income. And that sounds a little convoluted. So my best example of this is a t-shirt. Let's say you purchase t-shirts to sell them at a retail price. So you buy the t-shirts at a lower cost, which is a wholesale price, and then you sell them at a retail price. And so the cost of those t-shirts when you first buy them, plus the cost to ship them to you, are costs of goods sold, because you wouldn't have bought those t-shirts if you didn't sell those t-shirts. So the only reason you incurred that cost is to physically make a sale, which is very different from things like utilities, which you would pay whether you made a sale or not, right? Double entry bookkeeping, we talked about that. So it's recorded twice. There's a thing called a debit and there's a thing called a credit, and a double entry bookkeeping system requires both. So debits and credits, each bookkeeping transaction has two sides. It's double entry accounting. One of the transactions, one side of the transaction is a debit, the other side is a credit. Assets and expenses are increased by debits and reduced by credits. Income, equity, and liabilities are increased by credits and reduced by debits. This thing we could spend a lot of time on. Most people come out of this, out of accounting school, and they don't understand this. You kind of get this more with experience. It's also called a normal balance, like what increases a certain account type, what decreases a certain account type. You will get familiar with this. You're not going to learn it today if this is the first time you're hearing it, but in terms of a debit, assets and expenses are increased by debits and reduced by credits. Income, equity, and liabilities are increased by credits and reduced by debits. I hope I spelled that out as easily as possible. Depreciation is a write-down of value of capital assets. We talked about a car. A car is something that's a big ticket item, but you can't just deduct the big ticket item all in 1 year. So you have to take it over that amount that you paid, you have to take it over several years. And that is called depreciation. You would depreciate that asset over time, meaning you would take the cost and allocate it over time. Equity and capital, it's also called retained earnings, shareholders' equity. There's a ton of names for it. This is what's owed to the business owner, shareholder of the business. Equity includes money paid in by the owner, which is contributions, money the owner has earned but not taken from the business. Retained earnings, another type of contributions and stock issued. It is also reduced by any money that the business owner would take out, like a distribution. Expenses, money your business spends on operations and overhead. I'm pretty sure you've all heard of expenses and have a good understanding of what that looks like. Fixed asset, these are things like land, building, machinery, equipment, vehicles. These are big ticket items that you can't just deduct in 1 year. They're not expenses, they are fixed assets. Fixed assets are depreciated over time. Then we have fixed expenses. Fixed expenses, these must be met regardless of the sales level. So I kind of introduced this with the cost of goods sold thing, but a fixed expense is very much like rent. You're paying rent regardless of how much you use the facility, regardless of how many things you sell or how much money you made. You signed a lease, that money is due, the end, you pay it and it comes due, and it's the same amount every month. So fixed expense, just think of rent. Rent is a fixed expense. General ledger is a ledger that's made up of assets, liabilities, equity, income, and expenses. These are the 5 types of accounts, and it really goes in and shows you everything that goes on with those accounts. The journal is daily business transactions that are recorded there before they go into the ledger. So these are like the details. These are, okay, well, here's all the sales and this is who you sold what to. And then in the general ledger, it will say, okay, well, here's your income. And then all of these sales are in there. And so they kind of talk to each other. Liabilities, what your business owes. Liabilities include credit card balances, accounts due to vendors, accounts payable. Let's say you're a lawn and garden company and you bought a bunch of synthetic turf, but you haven't paid the bill yet because they give you 15 days to pay it without any interest. So you're going to pay it in 15 days, not right now. That is a liability because it's money you owe somebody. Loan balances, tax liabilities, anything that you owe money for, but you haven't paid out yet. Income and revenue is your sales of products or services, payroll, list of employees, how much you pay each one. Profits is what your business has earned after the cost of goods sold and expenses have been subtracted from income. Profit is not cash on hand if we haven't beat that horse to death. Reconciliation, the process of verifying the balance of certain accounts, checking credit card loans, etc., against the statements from an outside source. So you're going to be like, here is what we recorded in the books and here's what the balance is. And then you're going to go to the bank and say, well, the bank says this is the balance. And then you're going to make sure that they both agree. And if they don't, then you're going to resolve whatever the differences are. A subledger is a ledger containing the details, subset of transactions, very much like the journal, the day-to-day stuff. This is what happened. And then the general ledger is, okay, well, this is the balance of everything that happened. A trial balance is a statement that tells you if your debits and credits are accurate before you create your financial statement. So that's taking your daily ledgers to your general ledger, making sure everything reconciles and you're happy with it, and then creating financial statements from there. Variable expenses, if fixed expenses is rent, variable expenses is utilities. You're going to pay the same amount in rent every month because you signed that lease. You're going to pay your electric bill or your gas bill by however much electricity or gas you use. So if you are there more and you use more, you pay more. So that is a variable expense. Fixed rent, variable utilities. Gives you a really simple breakdown of that. Then we're going to get into the financial reports of it all. And we're going to read this. And I'm introducing it this way because I really like to break it out. Putting numbers on a piece of paper can be a little bit overwhelming for many people. And I did that. I put numbers on a piece of paper. But at the end of the day, in here, to get us started, I just wanted to show you how this works. And so we're going to read this flow from left to right, bottom to, top to bottom, left to right, top to bottom. So balance sheet has your assets, your liabilities, and your equity. Your balance sheet also includes your accounts receivable, which is an asset, and your accounts payable, which is a liability. Accounts receivable is things you owe money. People owe you money, but they haven't paid you. Accounts payable is people you owe money to, but you haven't paid them. Profit and loss is your revenue, your sales of your products or your services, your income, less whatever your cost of goods sold. If you purchase those t-shirts to be resold, that's your cost of goods sold, and less operating expenses. And your cash flow in this example, what we're doing in here is not a cash flow projection. We're doing a statement of cash flows, which is a little bit different. And the statement of cash flows identifies how the money came in and went out. They group it to whether the receipts or disbursements were coming from operating, financing, or investing activities. So it kind of identifies how the money came in and out, where it was used for. So the cash flow statement shows your cash receipts, cash disbursements, cash on hand at the end of the month. And then to further kind of drill it in, we're going to start with a balance sheet, and we're going to show you a visual, and then we're going to dive into the numbers on the screen. Just to kind of ease you into the nerdiness that is bookkeeping and accounting. So when we talked about the accounting equation, we talked about total assets equals total liabilities plus total shareholders equity. This visual shows you that the full assets in here is the same as the liabilities and equity splits 50-50. Now that may not be true. Hopefully you own more of your business than you owe somebody. that would be good. But whatever that equals up to, they total out whatever your total assets is. And then we're going to introduce some new terminology, current and long-term. Current means 12 months or less. If it's paying out within the next year, within the next 12 months, it's current. If it's longer than 12 months, it's long-term. So a current asset is a credit card. A credit card company is not going to give you 12 months to pay it off, right? But a mortgage will give you 30 years to pay it off. So the difference between a current asset and a long-term is how long you are given to either pay it or receive the payment from somebody. You owe somebody or somebody owes you. And it's either going to be collected in 12 months or going to be paid within 12 months, or it's going to be collected after 12 months or longer, or it's going to be paid after 12 months or longer. So assets, bank accounts, accounts receivables, that's money people owe you. Fixed assets, that's like your land, building equipment, vehicles, all of that good stuff. Other current assets is anything that would be collectible. Let's say it's a short-term CD for 6 months. That would be a current asset because you would have access to the funds in the CD instrument within 12 months. And a long-term asset would be something that would pay you back longer term. So let's say you invested in somebody's company, you gave them a loan, and you're going to get that loan back plus interest, but it's going to take longer than 12 months. Liabilities is accounts payable. You owe somebody, credit cards, lines of credit, loans, and again, the same with current and long-term. A current liability would clearly be a credit card. A long-term liability would be something more like a mortgage or the EIDL loan, the economic injury loan that the SBA issued out during COVID. Those things are kind of like a mortgage. They're 30 years. And then you have shareholders' equity, common stock. And these terminologies tend to work around corporations. There's other terms. There's equity, there's partners' equity, there's owner distributions, there's contributions, there's this, that, and the other thing. But common stock, additional paid capital, retained earnings, all of the fun things. And I promised you numbers on paper. Here we are. Numbers on paper. And the numbers on paper here, I just pulled off of Google and gave you a generic balance sheet. And we're going to break this balance sheet down into the 3 areas a balance sheet is. But if you were to look at it on one piece of paper, it would have all 3 in one page, typically, depending upon how many assets and liabilities and capital accounts you have. But in here, we're going to go in. And so we have some current assets. So we have some cash. We have some money that's owed to us. That's accounts receivable. There's some inventory, some t-shirts that we purchased to sell, but we haven't quite sold them yet, right? And then we have some plant and equipment, and then we have the depreciation that's taken over time, and then we have the net total assets. So that's what that looks like. Liabilities and stockholders' equity. So this really is the liability section. And so these are things that you owe somebody, right? So accounts payable, this could be your turf that you have 15 days to pay out, accrued expenses. Let's say you're on accrual basis and you have some other expenses very similar to the turf company where you owe somebody, but you haven't quite paid it yet. Unearned revenue is kind of a more complicated structure where the revenue is, let's say somebody gave you a deposit, right? But you haven't done any work around the deposit. So basically the deposit could be given back to that individual or business if you don't do the work or it's not done to their satisfaction. So this would kind of be like a refundable deposit, if you will. So you haven't quite earned the money, but they gave it to you. So woohoo, you got the cash, but you haven't quite cleared the end of the marathon. You've got to go and do the work or earn the money or whatever it might be, whatever the arrangement is. Long-term debt, we talked about what that would look like. Things that are older than 12 months or take longer than 12 months to repay. And then we're going to look at shareholders' equity. This is basically your ownership in the business. And right here, like I said, it's very much a corporation in here. If you're a partnership, this is going to look a little different. If you're a if you're a sole proprietor, this might look a little different. So it depends on how you set up your corporate structure as to what this would look like. But right in here, it looks like a corporation. A corporation could have things like paid in capital, which could include preferred stock and common stock, and then it will give you a total of both. Your retained earnings, these are things that have accumulated over the years in terms of your ownership, paid in capital and retained earnings. So if you put money into the business, added capital, the business, that would kind of go in there, and treasury stock. So these are all additional terms, and they're very specific to corporations. So there's terminology throughout the slide, so you can kind of go and look that up a little bit more if you want more information on it. And if I haven't drilled the accounting equation into you enough, this is my final soapbox moment of the accounting equation. So assets are what you own, liabilities is what you owe, equity is what you get. So assets equals liabilities plus equity. That is the accounting equation. And that is, you're going to hear that a lot. That's really important thing. So that's why I'm drilling it into you like a dead horse over here. Financial reports, the aging reports. So we're going to talk about accounts receivable is people owe you money. Accounts payable is money you owe. And they're basically the same thing in reverse. And I like this little cartoon because it's kind of plays on the accounts receivable, accounts payable thing. So if an invoice is due in 30 days, we pay it in 60. If it's due in 60, we pay it in 90. If it's due in 90, then they probably didn't need the money anyway, which is a cute little fun joke, but of course you're going to pay your bills. The aging report gives you a detail of how many days. So let's say you have $100,000 of accounts receivable, money you owe, or money somebody owes you. You are owed this money. And of that $100,000, how much has been outstanding for 30 days? How much has been outstanding for 60 days? How much has been outstanding for 90 days? And the reason, and even longer, the reason that would be reasonable for you to know, or why you would want to know it, is because how collectible is something that's been outstanding for 180 days, right? 180 days, if they haven't paid you in 180 days and it was due within 15, the likelihood of you collecting on that receivable gets lower and lower and lower the longer and longer and longer. And then the accounts payable, well, that has everything to do with whether people are going to lend you money. Are you not paying your bills on time, right? Was it owed in 15 days and you're paying it 90 and probably paying penalties and interest and all of this other stuff? So that really kind of leads you to the financial health. How collectible is your receivables, money that's owed to you? And how are you keeping up with your payables, money that you owe to somebody? So these are all things that speak to the financial health of your business. And we're going to move on. So now we're on to the profit and loss, the meat and potatoes of where you're probably going to spend the largest chunk of your business, right? And it's pretty straightforward in here. And because I started the other ones with a visual representation, I wanted to make sure I kept the same thing going here. So revenue is your sales of products or services. It can be called your income, your commissions, or any type of other revenues that you make in the operations of your business. Cost of goods sold, we talked about that with the t-shirts. If you bedazzled the t-shirts, if your glue and rhinestones would be part of your materials, your labor to put the rhinestones on and glue them in, the cost of shipping the t-shirts to you is cost of goods sold, and anything other directly associated. Fun fact, if you ship to your customers, it's not cost of goods sold, it's an operating expense. But if you ship the materials to you to sell, it is a cost of goods sold. So there's that little fun factoid. Operating expenses, and these can include both variable and fixed expenses. Rent, fixed. Utilities, variable. Advertising, payroll, office expenses, anything, meals, vehicle, whatever it is. If you have mileage, if you have software subscriptions, whatever it might be. Other income and expenses would be things that happen in the business when it comes to money coming in or money going out, but they have nothing to do with what your business is. So if you have money in a savings account, you earn interest, then you're not really in the business of making interest. So you're not lending money. And so you're not in the business of lending money and making interest is like your main point of business. So it's other income. Penalties and statements should have never been incurred in the first place because you should have had the money managed it and paid it on time. So they kind of live in this other category. And anything else that kind of happens outside of operations but still incurs. And then this statement goes to profit and loss. If you have more money if you have positive number after revenue less all of these costs, boom, you have a profit. If that number is a negative, then you have a loss. And your total profit less total cost of goods sold, less operating expenses, plus operating income, less other expenses equals profit and loss. That is so riveting. And if you wanted numbers on a piece of paper, well, here you go. I did that for you too. So in here we have a sample, and it can look a number of different ways. It could be structured a number of different ways. This is going to be more specific to your industry, your business, and what's important to you as a management running the business. So you see that you have sales minus cost of goods sold equals gross profit, yet another vocabulary word you can look up. The gross profit is basically what it took you to make those sales. That is the t-shirts, the cost of the t-shirts you sold, and what came out of those direct costs is the $25,000 here in this case, to kind of put a fine point on it. And then you can group things like that would make sense. So if you want to say, okay, these are the costs of selling, these are administrative costs, these are, you can group them by department, you can group them by different types of activities. You can say utilities, but you want to break out gas, electric, all of that good stuff. Maybe you want to break out telephone from utilities or telephone from office expenses because the next person who wants to tell you that they can give you a cheaper phone, well, maybe you want to have a report where you can run and find that number. Well, this is what I'm paying. What can you give me, right? And so that kind of helps there too. And then it gives you down to your operating income. And then we roll through things like your non-operating income and expenses, interest and revenues. Let's say you sold an old vehicle on hand, and let's say, I don't know, it was a really great vehicle, so you made $3,000 on the deal. That would go in here. If you paid out interest, let's say you got sued. Let's hope that's not the case. So things, like I said, that are not in the course of operating your business kind of land in here. And then you have your final net income at the end of the day. Then we're going to go to statement of cash flows. The statement of cash flows, like I said, you're going to hear about cash flows in terms of projections, right? In terms of projecting numbers, how much money do I need to make payroll, blah, 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 blah. This is a little bit different. This is saying, here's what happened, and then saying, okay, well, here's what happened for the operating piece of the business. Here's what happened for the investing piece of the business and financing piece of the business. So we'll kind of go through this real quick here. Statement of cash flow summarizes the movement of cash that comes and goes out of a company. It also highlights the company's ability to manage their cash. So operating activities include things that would go into operating your business, like selling things. I know interest income was not an operating on the profit and loss. It's a little counterintuitive here, but it lands in operating in terms of your statement of cash flows. Your cost of goods sold, that's what COGS stands for, and your operating expenses like rent and utilities and payroll and office supplies, and we could go on. Investing is things like purchasing or selling of assets, like a car we talked about. Accounts receivable and accounts payable, that's money you owe somebody or money somebody owes you. And financing would be more of dividends that you're paying out to your shareholders, stock repurchases, payments of debts and loans. Clearly that would be financing as it would make sense. And then we're going to roll into numbers on paper like we talked about. So numbers on paper, you go with, and there's two methods. There's a direct method and indirect method, and we could spend an entire semester on the statement of cash flows. It's a little bit of a complicated topic, but it's nice to get a good little introduction here so you understand it when people talk to you about it, and you know the difference between like a cash projection and a statement of cash flow. I think the terms get interchanged and it can be confusing if you actually know the differences. So in here, it starts with the net income and it works into things that are operating, depreciation, increase or decrease in accounts receivable, so on and so forth. Investing activity. So we sold some equipment, we lost some money. Let's see, financing cash flow, payment on debt. So let's say we paid down some of our debt, we gave our partners some money, and then at the end of the day, we have the change in cash, the cash at the beginning and the cash at the end. So it kind of reconciles back to the balance sheet where the cash balance beginning and ending kind of show up. All right, ratios. We're going to go through this kind of quickly, and these are things you can look into a little bit more after this presentation. Like I said, we're going to give you a copy of this PowerPoint, so you will have this reference point to go back to. But in here is kind of a nice little thing. So the business break-even point is basically how many t-shirts do I have to sell to make no money? Right? Let's say I got nothing else going on except for the cost of the t-shirts. Let's say we're like operating at no other cost. How many t-shirts do I need to sell? So it's your fixed cost divided by your profit margin. So in here, the gross margin is your revenue minus cost of goods sold divided by revenue. So I, because this gross profit margin came into here, I put that into here. So the break-even point is a point where the income for the sale of goods or services equals exactly the cost of sold. The exactly equals total cost. So that's what that is. And we'll move on down to the current ratio. And the current ratio measures the liquidity of the business, its ability to meet its current obligations. And so you can see this equation in here. And so if somebody's investing in your company or trying to lend you money, or if you're trying to make decisions or meet benchmarks, this is where these ratios are going to come into place and be useful. Debt to equity evaluates a company's financial leverage, its ability of the shareholder to cover all outstanding debts in the event of a business downturn, i.e. COVID. March 2020, what does your debt to equity look like? And that might be an indicator of whether you can survive the pandemic, right? Retained on earnings, that's what ROE stands for, retained on earnings. I'm sorry, retained on equity, excuse me. Retained on equity measures the financial performance here. We talked about the gross margin, which is this equation here. Your quick ratio, which is your acid test. It's an indicator of a company's short-term liquidity position and measures a company's ability to meet its short-term obligations with its most liquid assets. And then we have the working capital, which represents a company's ability to pay its current liabilities with its current assets. So ratios to know and love. And at this moment, we have just over 10 minutes. So I'm going to hand it over for Q&A. We'll have Anna come back on the phone and on the speaker, and she will tell us what questions, what comments we're in, and we will try to answer everything that we can.
All right, sounds good. I'm back, Amanda. So just answering a question here that was sent in that asked if there would be a transcript. And I'm just clarifying that we are going to make this webinar available on demand and on the YouTube channel. But right now we don't provide a transcript of the recording. If that's something that would be of help to you, go ahead and contact me at nmsbdcwebinars@sfcc.edu. I provided that in the Q&A chat, and I can see what I can do. So yeah, don't hesitate to reach out. And then there's another question by the same person. Do I need to use a special dictionary for definitions for terminology?
You know, there's different terminology for specific industry and accounting specific. Like a debit and credit is different for a bank in the banking industry than it is for accounting. But I think if you look into it, and you start with Google, it will tell you if you're getting something that's not making sense. You can, go in and identify, hey, I want the accounting definitions versus like something else. But I don't think there's like a Webster dictionary for accounting terms specifically. But what I would say is start with Google. You also have a ton of information through the SBDC that gives you a ton of information on this. Again, this webinar is also going to be available over YouTube, and there's so many resources available to you, and maybe taking a bookkeeping course could also help solidify that as well.
Awesome. Thanks so much, Amanda. And then we've got some more questions coming in. Can you recommend a good platform for bookkeeping for beginners? And also just wanted to let you know, the more resources you can let us know or recommendations you have for us, the better. So feel free to throw a couple of platforms or ideas out there for us.
So platform, I'm assuming like accounting software, right? If that's not the case, go ahead and correct me. But it sounds like these would be things like how to keep the books, right? What software? Our business uses only QuickBooks Online, but there is so many platforms. Every accountant has their likes and dislikes on the software that they use. QuickBooks is kind of a double-edged sword because it makes it really easy, but it also makes it really easy to do kind of things that maybe you shouldn't want to do. But nothing in QuickBooks can't be corrected. There's also other platforms. I do not prefer Xero. I know a bunch of other bookkeepers and accountants that like Xero. Xero is spelled with an X, not a Z. So Xero, there's a bunch of other platforms. And even if you're just starting out, like any software you purchase is going to cost money. So it really depends on how far along you are with your business and your budget and how many transactions you have, how much volume you have to do, how complicated it is, what kind of invoicing you need to do, if you need to do any. So you can get away with doing it on Word or Excel if you want for a little bit, but regardless of what platform you use, I would recommend that if you're going to do your own books, to make sure that you're honest with yourself on whether you're going to do it or not. Because if you're not going to do it, you're going to wait until today, which is 4/12, and taxes are due on 4/18. And right now you're going to be like, oh, I have to do last year's books. You're going to be miserable. It's not going to go well. You're going to be very displeased with yourself. So whatever system you use, and there are many out there, we use QuickBooks Online. And there's different versions of QuickBooks Online. And please, if you go with QuickBooks Online, use business, not self-employed. Do not use the self-employed platform. Please don't do that to yourself. You will be very upset. Your bookkeeper and your accountant will be very upset. But whatever platform you use, make sure you use it. That would be my biggest thing.
And we did hear back with confirmation that they were asking about software. And then there's a secondary question kind of relating to what we're talking about. Preferred bookkeeping software, you've already addressed this, but just in case anything else pops into your mind, that's liked by accountants like FreshBooks. So if you have any others that you happen to know of that you want to throw out there, feel free to.
I don't know anything specific. Accountants really like accounting software, and accounting software is not really, it doesn't lend itself to somebody who doesn't actually know accounting, meaning you haven't had a 4-year education in accounting and you haven't had 4 years working under a CPA doing accounting type stuff with the experience. Once you kind of move out of that little area, there's upsides and downsides to everything. So I would find the one you like. I have a client who came to me and she's using Wave. And Wave is free. So of course it was ideal, right? But then I go into Wave and I'm like, here's why I don't like Wave. And not to say that Wave isn't a great starting point. I think the software would be useful if that's where you wanted to go. I can't say that FreshBooks is good or bad or any other thing. I can say our clients specifically and what we work with is QuickBooks Online. So.
We've also got someone saying, I was told the same about what version of QuickBooks to get. Business. Do not get self-employed version. So thanks for
Don't do it. There's honestly, the self-employed is on a very different platform, so you can't just upgrade. And what self-employed offers you does not give you what you need to run your business. It doesn't give, I don't think it gives you a balance sheet. I'm not sure you can reconcile your bank account and self-employed the last time I looked at it. So don't do self-employed. You want the right proper checks and balances and get the business version.
Good to know. I don't see any other questions and I don't see anything in the chat. That being said, feel free to throw something in there if you want to. In the meantime, just wanted to remind you all that the New Mexico Small Business Development Center is here to help you during any stage of your business. So don't hesitate to reach out to us. As you know, we have these no-cost webinars that are available, and we also have no-cost counseling services. So don't hesitate to reach out to us. And I do see some additional questions coming in. So let me go ahead and read those. For a beginning sole proprietor, what is the minimum amount of accounting paperwork reports that are required?
Reports, I would think your balance sheets would be a good one, and your profit and loss would also be a good one. The statement of cash flows is a bit overkill. In terms of record keeping, if you're taking an expense as a deduction against your income, you should have a record of it. If it's just because you use your debit card, it shows you a line item on your bank account, that's okay. It would be great if you had a copy of the receipt somewhere, maybe a digital filing system, be it Google Docs or something else, Dropbox, whatever. It'd be really great to have that level of detail where you could actually point back to the receipt, or if you wrote a check, have an image of the check, so on and so forth. If you're going to deposit something, like say a check, somebody wrote you a check, having those images is actually going to serve you well. So I don't think that you can over document, but if you have the information that explains what happened and what transpired, and it can be supported that this is it's an expense or an income in the ordinary course of the business, then I think that that's enough to substantiate the record that you need. I don't know that there's a certain number of receipts you have to keep. I would just say whatever is reasonable. There's a benefit between the time it would take, right, to have all of this detailed record, and then the difference between like what it costs you to do. Like, are you going to lose a contract because you don't have enough time in your day for your family, your kids, your this, that, and the other thing? Maybe you have a day job and whatever. And if you're losing sleep over this, then you just kind of need to find balance there. So I think there's that. The other thing is that if you're going to take mileage as a deduction for your business, let's say you have to go somewhere to do your job, then you should have a mileage log. You should have, okay, well, here's the beginning number of miles I had this year, and then this is the trip I took, and this is why I took it, so on and so forth. And then at the end of the year, you would say, okay, this is the total number of miles. Here's the total number of business expenses or business trips, so on and so forth. You are required to keep a log if you're going to take mileage as a business expense, and you can do that digitally. There's applications on your smartphone. I think Mile IQ is one of them. I think QuickBooks Online builds that into their system. So there's ways that you can do it, or you can go down to Office Max or Office Depot or Staples and buy a paper thing where you can actually go physically write the trips in. So again, it's going to be whatever the system that you'll do works best for you, but you're going to need to keep track of that mileage log if you're going to take miles as a deduction for your income tax return.
Thanks again, Amanda. And yeah, I don't see any other questions. I do see a couple of thank yous coming at us. And yeah, with that being said, really appreciate your expertise as always, Amanda. Such a pleasure to have you, and everyone, thank you so much for your attendance. And then I will see if there's anything else that you want to say on your end. Otherwise, we can go ahead and wrap it up for today. Thank you again, everyone, for your attendance.
I think it's great, and definitely reach out to the SBDC if you need anything further. Go ahead and look if you need anything more. We talked about additional resources. There's WEST, WESST, there's SCORE. SCORE. There is, God, how many other things are there? The CNM offers different courses. The state has different trainings for different things for grocery receipts and stuff like that. So yeah, absolutely. If there's something that you need, come to the SBDC first. But there's plenty of resources out there, and I do appreciate your time for coming and joining us and nerding out with us on this basic bookkeeping course.
Thank you so much, everyone.